Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. My name is Robert Kuhn. Thank you for listening. This is Destination Retirement. If this is your first time, welcome. If you have listened to the show in the past, welcome back. If you're catching it on the podcast, thank you for joining us. Please send the link on to somebody you believe that can benefit from listening to the show. My name, as I mentioned, is Robert Kuhn. I do host Destination Retirement. I'm also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and yes, we are a fiduciary. The job of any good fiduciary, of any good money manager, is crafting a portfolio that can deliver positive returns, even in negative markets, for some of your money. That is what we focus on. We're also financial planners. We believe in tax mitigation. We believe in maximizing income. And yes, you do need a plan. Anything that I say during this show or past shows that piques an interest and you would like to discuss it in further detail on how it could benefit your individual situation, please give Paige a call, 630-492-1912, 630-492-1912. We have volatility. Volatility is back. Imagine that. Yes, it is back. This week was pretty volatile, and I think we're going to continue to see volatility. And so we want to make sure that investors are prepared, and it is something that we spend an awful lot of time on the radio show talking about. I do know that sometimes for those that listen to the show frequently, they understand that I do go over many of the same topics over and over again, and that's just kind of the nature of the beast. And most individuals, catch the show just, snippet or they catch it for 5 to 10 minutes on Saturday, and something I say at that time piques an interest and they reach out. So I do apologize if I repeat myself, but again, our job is making sure that we're selling you education, that we're bringing to the table strategies that can greatly reduce your taxable income, that can deliver positive returns when the markets are down, especially if we're going to see volatility throughout the year, which, most people believe that is going to be the case, and we kind of fall into that camp as well. For those that are new, we do believe in banknotes, and I wanted to give you the most recent pricing on a note that we just priced. JP Morgan is backing the note, so it's a JP Morgan note. This note pays 12% annually. That pays 1% a month, and you get that payment as long as the indexes that the banknote is tracking are not down more than 30%. So basically, you have 30% downside protection to make 1% a month, 12% annually. If you believe that JP Morgan is a strong, credit-worthy bank, then this is a note that obviously you want to learn more about. We do price these notes a couple times a month. Again, we price 10 to 12 different banks generally, and so all of the banks are what we would consider too big to fail banks. So anytime you do a bank note, it's backed by the credit of the bank. So you have to make sure that you're obviously working with a strong bank. So the JP Morgan note, it was an income note. Again, 12% annually, pays 1% a month. And you get that 1% a month as long as the indexes that the note is tracking are not down 30%. So one way to look at it is you have 30% downside protection to make 12% annually, 1% a month. So if you want more information on that, give us a call, 630-492-1912, 630-492-1912. I actually saw a really, really interesting question this week, and it is something that I wanted to make sure that I talked about on the radio today. Question was, I was reading and doing some research, and it said if you knew the S&P 500 was going to be flat over the next 5 years, what would you do with your money? And I thought that was very, very interesting. So think about this. If you knew the S&P 500 was going to be flat over the next 5 years, what would you do with your money? And I really think it's important for you to think about that because, it's hard to make big calls as far as, market direction, which way we think the market is going to go. Certainly people do that. They're generally trying to sell something. I think if you look at, the markets, we could think the markets are going to go up. We could think the market's going to go down. But at the end of the day, the markets really don't care what I think, what you think, or what anybody thinks for that matter. But I do believe that if you look at the market, a lot of the easy money has been made. And if you've listened to the show for any length of time, you understand that most advisors, unfortunately, are going to not talk about strategies that can really have the most impact when you need them most, which is when the markets are down. My concern with the markets today is high inflation, low growth, and what does that mean over the next 5 years? A case could absolutely be made that the market's going to be flat over the next 5 years. And I think you need to, if you're working with an advisor, I think you need to ask them, what do you have inside of my portfolio? What am I allocated to that if the market is flat to down, pick 1 year, 3 years, 5 years, 7 years, 10 years. I mean, pick whatever number you want. But this question was 5 years. What do I have in the portfolio that'll actually do well during that period of time? Most advisors, unfortunately, are going to hem and haw. They're going to try to talk over your head. And the reason they do that is because they have no strategies in place that can deliver in a flat market to down market. And I want my clients to be able to answer that question. If you're working with us, we just talked about a banknote, right? We just talked about a JP Morgan income banknote that is paying 12% annually as long as the indexes that the note is tracking are not down 30%. So if we had a note like that and it lasted 1 year, 3 years, 5 years, 7 years, 10 years, well, the answer to that would be, well, if the market's flat, we're still going to make 12%. Those are the things that I really want you to start to think about, because if you look at the upside for the stock market, given current valuations and earning growth assumptions or expectations, they're stretched, and they certainly could become more stretched. But what has to happen before we see the market ultimately correct in a relatively big way? If you look at kind of the hedge fund space and you look at what the big money is doing, hedge funds actually dump stocks at the fastest pace since March of 2022. That's concerning. And if you look at, what is going on in the market today, and if you look at kind of what the bigger pools of money are doing, they're becoming defensive, and they have been becoming defensive for a rather longer period of time. Bank of America, they actually looked at the S&P 500 statistically, and they looked at 20 metrics as far as, is the market expensive or cheap? And statistically, the market is expensive in 19 of the 20 metrics. And what does that mean? Well, it doesn't mean that the market's going to initially crash. It doesn't mean that the market ultimately has to go down. But it does mean that there is a potentially meaningful correction coming. And that, to me, is a concern, because you look at where we're at today. And when we meet with individual investors who are not working with us, the first thing that I ask them is obviously, what do you like? What don't you like? And the biggest concern that most individuals have who are not currently working with us, those that we have the opportunity to talk with, whether they come in from the radio show or whether they attend a dinner that we host throughout the Chicago area, is that they're not certain. They're not, they just don't know if their portfolio could handle a meaningful correction. And that is concerning, and it's concerning to them, and it's concerning enough to them that they're reaching out to somebody that they don't know, and they want to get advice, a second opinion, and really just kind of make sure that their portfolio could handle some sort of a meaningful correction. Because, personally, having been at my desk through the late 90s, the 2000 crash, and 2008, and then obviously, all of the good and the bad in between there, I'm surprised that anyone thinks that the current market is not starting to look very, very expensive. And that is a concern. And, we do a lot of research. We have a lot of, different sources. We have a lot of, contacts in the industry, like most advisors do. But Goldman Sachs, it has been said, now I'm not a client of Goldman Sachs, so they didn't tell me this, but it has been said that they are telling clients to get cautious on the stock market, and they see a risk of a rather significant correction on the horizon. And that's, something that I want to make sure that we're continuously educating individuals on the radio show, because A, we have a voice, and B, you're not currently working with us. Most individuals listening to the show are not currently working with us. And so we can be very objective, which I think you should always be objective, but you can be very objective. We can be very objective on the radio, because we just want to look at statistics. We just want to look at, if you look at technical indicators, and if you just look at where the market is predicting a probability of a recession by December 2024. It currently sits at around 63%. That level has only been seen 3 times since 1960. So 1974, 1980, 1981. And yes, all 3 ended in severe recessions. And so, yes, the chance of a recession, it is very elevated currently. And it is somewhat of a concern, because I don't think that advisors are really doing all that they can to protect their clients' assets. And that is something that we want to spend a lot of time on. When you meet with us, we're going to spend a lot of time on talking about strategies that have the ability to protect principal, which those exist. Some are good, some are bad. I mean, there's always a pro and a con. But, there are strategies that can protect principal in a down market. And then, again, there's even strategies that can do well when the markets or deliver positive returns, even when the markets are down. So if you're listening to the show for the first time, again, I want to thank you for joining. You can reach out to us with any financial questions, 630-492-1912, 630-492-1912. And, again, we just want to make sure that, the probability of a recession is high. It's only been this high 3 times since 1960. And all 3 ended in severe recessions. And if you are protected, if you have the right strategy in place, you're not going to be controlled by a down market. You're actually going to use a down market to your advantage. You're going to, be actually, if you look at, what you want to do when the market's down, if you have the right strategies in place, you're not worried. You know that, you're making money with some of, your assets in a down market, and that allows you to ride out the volatility, when for some of your assets. So with that being said, if you have any questions that you want to address, if you have any questions on tax reduction, tax mitigation, those strategies do exist as well. Just give us a call, 630-492-1912, 630-492-1912, and we will be happy to address those. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and yes, we are a fiduciary. Thank you for listening to the show. If you're catching the podcast, thank you as well. We see the podcast numbers. They continue to go up and to the right, which is what we like. We ask if you find any value in the show, and if you're listening to it via the podcast, make sure that you share the link to anyone that you think could benefit from our advice or the way that we look at the world. We have been told that people like our radio show because we are not selling anything, but we are actually selling something. We're selling education. We're trying to educate investors in, if you can, the show does run in multiple markets. So if you're listening to the show, then you know that we can work with you. If you're hearing the show today, you know we can work with you. We are located just outside of Chicago in Naperville, Illinois. That being said, we do have a national client base. And again, if you're listening to the show, we can work with you. So we do sell education. We do sell the ability to, we want to make sure that we're putting you on the same level playing field on in providing the same options that your advisor uses. But generally, if you look at your advisor, they're going to manage their own personal money significantly different than they recommend you to invest in how they manage your money. And we're on a mission. We're on a mission to change that. We're on a mission to make sure that individuals are not just riding the roller coaster up and down, and you're not just tracking the market up and down. And that's something we're very passionate about, and that's something that we're going to stick with. So 630-492-1912, that's our number, 630-492-1912. If you have any questions that you would like to have answered, set a time up to either come into the office or to have a Zoom call or a conference call with myself. We'll do all that we can to address any thoughts or concerns that you have. So Amazon, if you had bought Amazon stock back in September 2020 and went into a coma, and you just woke up today and you are like, am I rich today? Did the Amazon stock go up? Well, actually, you would have made pretty much zero. In fact, in real terms, your investments would actually be down. So now go back to sleep, right? No, but it's, when we hear people think that, the markets can't go sideways for an extended period of time, it can, it does. And we talk about, Amazon and just showing you that, in 2020, in real terms, you're actually down. Had you bought Microsoft in 2000, it actually took you 12 years just to get back to even. So we've been in a really great period of the market. We've had the market just continuously go up, and there's been very, very little volatility. And now, again, this week, there have been some volatile markets. The markets have been volatile. But here's the current situation as I see it. Stocks are falling like the top is in for big tech. Gold prices are falling like stocks are rising. Bonds are falling like we are heading for a soft landing. Oil prices are falling like we're heading for a recession. Natural gas prices are falling like there's no demand. Big tech stocks are falling like the AI hype is over. And so there's a sudden rush to the exit, right? I mean, what do you do? And, when we look at, the market and everything that I do is really to just make sure that we're providing our clients with the opportunity to make money in an up market, a down market, and a sideways market. And if you really boil down investing into its simplest form, there's just really three ways the markets can go. They can go up, they can go down, and they can go sideways. And almost everybody listening today, if you have $100,000, if you have $100 million, you're going to make money when the markets go up. Chances are you're going to make money when the markets go, you're going to lose money when the markets go down. And then in a sideways market, we just don't know. That just shouldn't be good enough for you. That should not be good enough for you to accept, because we see headlines like the following. The stock market could fall by 50%, warns a specific hedge fund manager who sees the greatest bubble we've ever seen is approaching its peak. I don't know. I mean, those are the headlines that we're getting, and those are, what we're seeing out there. And could it happen? Absolutely could happen. I mean, without a doubt, it could happen. Is it likely to happen? I have no idea. I mean, that's the reality of the situation is just there's so much that is hard to model today. I mean, we do know that the market is very concentrated. If you've listened to the show for any length of time, you understand that as of at least a week ago, I haven't seen the updated statistic, or maybe it was 2 weeks ago, but the market, the top 10 stocks represented 77% of the market return. And so, yeah, it could easily fall. And there are many hedge fund managers. And one of the reasons, you listen to hedge fund managers is because the bulk of their personal money is in the fund that they're running. So you're going to get different advice when it's their own money versus client money. And that's one of the reasons, you listen to and who we gravitate towards is we love listening to individuals who have their own capital at risk, because people tend to look at money differently when it's their own. And, that may not surprise you, but and that's one of the things that, when we look at kind of advisors, and I think one of the greatest questions to ask an advisor is, are you managing your personal money the way that you're recommending that I manage my money? And I don't have any statistical, there's, nowhere that you can find that people report in our advisors managing their own money like they're managing clients' money. But I'm here to tell you, just based upon my experience, that there's a significant difference in the way that individual advisors manage their own money versus the recommendations of how they manage client money. And that's unfortunate. And again, we're here to try to change that. We're here to try to give you the best opportunity to make money no matter what is going on in the market. So I mentioned a question earlier in the first segment. If you knew the S&P 500 was going to be flat for the next 5 years, what would you do with your money? And I really want you to think about that, because there is, I don't know what the probability could be, but I think there is a good statistical probability that over the next 3 to 5 years, that at these current prices, that the market is flat to down. And so that could be based upon where you're at in your life, where you're at in your investment time horizon. That could be very detrimental to your situation. If you're in your 50s, late 50s, if you're in your 60s, if you're in your 70s, what could happen if we're in a flat period for 3 to 5 to 7 years and inflation is doing what inflation is doing? And that just could be a challenge. And I want you to really think about that. How would your portfolio handle a flat market to down market? How would you still make money? Would you make money? Would you lose money if the markets were flat to down? And if you can't answer those questions, we want to help you answer those questions. So 630-492-1912, 630-492-1912. Tax reduction, we are having a dinner and a lunch in Naperville in late August. If you're a physician, if you're a high wage earner, if you sold a business, if you're a business owner, if you would like to drastically reduce your taxable income, this is a lunch and a dinner that we want to invite you to. I love lunches because people who come to lunches, they're very interested in what we have to say. And if you've listened to the show, you know that the energy strategy that we utilized last year reduced your taxable income by $90,000 per $100,000 invested. Now, that was a little higher than we anticipated. We like individuals to kind of budget for that $70,000 to $80,000 per $100,000 invested. But if you want to reduce your taxable income, if you're a high wage earner, if you've just had a liquidity event where you sold a business or a property or exercised stock options, we want you to come to the dinner. And if you don't want to come to dinner, and if you want a little bit more of an intimate setting where it's a smaller group, we do have a lunch as well. So it's going to be the 27th and 28th of August. So get on that list. They do fill up very, very fast. We're going to talk about our energy strategy and how to greatly reduce your taxable income. 630-492-1912. Just let Paige know you want to attend the lunch or the dinner. 630-492-1912. So August 27th and 28th. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. If we can assist you with any questions that you have when it comes to investing, you know we're here to help you. 630-492-1912, 630-492-1912. End of last segment, I had referenced our dinner in Naperville. I expect these dinners to be, well, all of the dinners, fill up pretty quickly. But given where the market is and what's going on in the market, we'll probably have these fill up faster than they normally do. But I want to make sure that you know that we have decided to have smaller group lunches on the days that we do the dinner, and we want those to be a little bit more targeted. And so we have a lot of, obviously, tax strategies that we talk about. So that the point of the dinners in this, specifically the lunches, is to go over tax strategies that can greatly reduce, your taxable income. And if you've listened to the show, you understand that the most overlooked area, in my opinion, of financial planning is tax strategies. The tax strategies that you're getting from the big banks and from a big brokerage firm, if that's who you're working with, they're just not really proactive in any way. And we look at strategies, especially in the energy space, that can reduce your taxable income by $70,000 to $80,000 per $100,000 invested, and that's active or passive income. Now, I have to caveat that by I can't provide tax advice because I'm not licensed to, but these are very, very basic tax strategies. So take them for educational purposes, but we do go over ways to reduce your taxable income. So if you do want to get to a lunch on the 27th and 28th, it's about an hour and 15 minutes. So if you're close to Naperville, we do them at Morton's, and we do have access to I don't know what the attendance is yet for the dinners, but as soon as the invitations go out, they'll fill up almost immediately. So 630-492-1912, 630-492-1912 if you want to talk about ways or learn about ways that can greatly reduce your taxable income. I want to spend just a couple minutes on hedging. We talk obviously an awful lot about ways to make money when the markets are down. And as you think about it, hedging is a really basic term. I mean, you do it in most areas of your life, whether it's life insurance, health insurance, auto insurance, homeowners insurance, etc. And it's really there to prevent the unknown and try to allow, if the unknown happens, try to mitigate loss in whatever area that you're trying to hedge away. And when it comes to investing, unfortunately, most individuals, they just have no hedges in their portfolio. And it's not you. I guess it's you if you're managing the money on your own. But if you're working with an advisor, I want to take them to task in really the fact that they just simply don't have any hedges inside of individual investors' portfolios other than the markets going up. And that's a real challenge. And that's a real challenge in this market. So I want you to think about, what do you currently own inside of your portfolio that is a hedge? Do you have complex hedges? Do you have basic hedges? All of them exist. And when we talk an awful lot about the bank notes and the income notes, individuals are shocked to know that you can make money if the markets are down. And that's what most money managers, what most banks do. I mean, I thought I read a statistic the other day that AI was hedging a lot of JP Morgan's equity book. Now, I can't remember exactly where I read that, but when you look at what the big banks are doing, and if you look at insurance companies and you just look at most companies, they always have hedges in place. But yet when it comes to the individual, there is no hedge in place. The only hedge you have is time and an up market. And that's just unfortunately not good enough, especially in this market. And so when we talk about hedges, I mean, there are some very basic hedges. One of the, we talk a lot about annuities. And if you've listened to the show, you know that we don't have a very fond affinity to lifetime income annuities, guaranteed lifetime income annuities. That is a hedge, but unfortunately it's a hedge that you're probably not going to take advantage of. And if you do own a guaranteed lifetime income annuity, I want you to think about a couple things. Number one, do you realize that you're only taking your own money out of that annuity until the account goes to zero? When the account goes to zero, then yes, the insurance company is going to start to pay you from basically their money. But the way that the insurance company hedges that won't happen in many instances is how much they let you take out of that account. And each year there's a governor, and they limit the growth. And that is how they're hedging to make sure that while they're telling you you're going to have guaranteed lifetime income, but you're paying for something that you just are not going to take advantage of, because again, until that account goes to zero, you're just taking your own money out of that account. But that is a form of a hedge. And so people like to say that we don't like annuities, and that couldn't be further from the truth, because one of our favorite strategies in the market today is a 5-year annuity. And it's what we consider to be a growth annuity, where there is no lifetime income component. It is just 100% principal protected, and you get a component or a percentage of the growth of the S&P 500 each year. Currently, that rate is 11.5%. So you're capped at 11.5%. So from 0 to 11.5%, you get 100% of that return. That's a hedge. You're hedging against a down market. Your worst year is 0. So if you put that up against a guaranteed lifetime income annuity, man, I just have to think that most individuals would want that strategy, especially given that it's only 5 years. And when you get a gain, that gain's locked in every year, not to be given back in future down markets. So that is a hedge. And if you have IRA money, and if you're concerned about the market, if you've lost money in bonds, especially, in the bond market, we're in the worst 4-year drawdown in history in the bond market. Well, here's a way that you can sleep at night to know that your worst year is 0, and you get the first 11.5% of whatever the S&P 500 does, and you're capped out at that 11.5%. And if you get a gain, that gain's locked in. That could be a really good strategy if we see market volatility. That is the most basic hedge, and it's only 5 years. 630-492-1912, 630-492-1912. So yeah, if you do own a guaranteed lifetime income annuity, let's have a conversation. Please, please, please. We're probably going to have you look at it in a way that whoever sold that to you should have had you look at it, but they didn't. So you can't say we're against annuities because we have the 5-year strategy that we love, but we are against annuities that we think that the individual isn't going to benefit from. So a couple minutes left in this segment, and let's talk about financial planning and what financial planning is and what financial planning is not. Financial planning is nothing more than a roadmap. It's a roadmap to have you be able to look at your current situation, where you're currently at, where do you want to go, how are you going to get there, and then really have checkpoints along the way. And I see far too many investors looking and not making changes to their portfolio because they have a quote-unquote financial plan. And like I like to say often, a financial plan's not worth the paper it's written on if you lose money. So when we look at kind of financial planning, we're looking at it a little bit differently. We think that the financial plan needs to be very dynamic. We think the financial plan has to be updated consistently. And the software that we use actually ties all of your accounts into that plan. And you're able to actually look at that at any point in time and see where you're at along that journey. When you look at financial planning is very, very important. But financial planning is not something that you just look at one time and then you never look at that again. And we see that, far too often when it comes to the financial plan is it's done once and then you never look at it again. When you look at financial planning, it is important. It is something that we believe should be the core of every advisory relationship. But we have to look at that plan often. We have to make sure that we're looking at that plan continuously so we can really gauge where we're at, especially when the markets are dropped. Because a financial plan, there's so many issues with kind of financial planning software. And you look at kind of Monte Carlo analysis where they take randomized scenarios of randomized generated returns in the market, and it gives you a probability of success. Even if you have a 90% probability, well, you still have a 10% probability that your plan doesn't work out. And that's something that I think, we have to look at, and we have to make sure that what are you doing if that 10% happens? 9 out of 10 times it's not going to happen, but what happens if it does? What do you do? What is your backup plan? If you fly in a plane, pilots and planes, they have backups to backups to backups, right? Well, what about your financial plan? What is your backup? If you don't know what that is, if you don't have a backup, then why are you working with the current advisor that you're working with? And changing advisors today is relatively simple. So if you don't have a plan in place, you should. If you have a plan in place but it hasn't been updated, it should be updated. So we want to make sure that you're utilizing the most cutting-edge strategy, most cutting-edge financial planning software that connects to all of your accounts and that you could log in and you can look at it at any point in time. And if you don't have that and you want that, or if you want to learn more about that, obviously give us a call, 630-492-1912, 630-492-1912. Should investors be concerned about unusually calm markets? That's such a great thought, right? And yeah, I think investors should be concerned about unusually calm markets. I think that's when you actually want to be concerned, because there's only been 9 days in 2024 where the S&P 500 has actually fallen more than 1%. And when you look at the lack of volatility, it is corroborated by the VIX, which is just a gauge that investors, kind of their expectations for ups and downs in the S&P 500. And actually, the VIX has averaged 13.8% this year and is on pace for its actual lowest annual reading since 2017. So, yeah, I think if you look at, throughout the first half of this year, and even if we go back to the start of the current bull market, which we can debate on when that was, but we go with October of 2022, stocks have climbed the proverbial wall of worry, and investors have had plenty to worry about. No doubt about it, from recession fears to higher interest rates to lofty inflation. And the latest worry really is the top heaviness in the equity market. So, yes, there is concern. And but you know what? That other than this week, it really hasn't dented the momentum for stocks. But can it continue? And I think that is something that we really, really have to focus on. And when we look at can it continue, because when you look at investment management and you look at financial advice, it's not what has happened yesterday. It's not what has happened over the last year. It's really what's going to happen tomorrow, what's going to happen in the next 6 months, 12 months, 24 months, et cetera. And it's not trying to predict the market. It's not trying to look into our crystal ball. But let's take a look at some data to explore some of the possibilities. And we've had one downturn in 2024 that could be considered mild, a 5.5% decline for the S&P 500, which happened in April. And that drawdown was relatively benign. If you look at, relative to the smallest first half downturns, going back to data from the 1950s, the S&P 500, there's just been very, very little volatility in the market. And when we can look at, the fact that the S&P has not experienced a single day sell-off of more than 0.4% since May, that is somewhat concerning. So if we look at, where do we go from here? I think, much like the weather, markets are impossible to predict, but that doesn't mean that you shouldn't have safety in place. That doesn't mean that you shouldn't have strategies in place that can greatly reduce your taxable income and can still do well if and when the markets do go down. Because again, if we just look at statistics, the first half of 2024 was the 14th best first half since 1950, and the best first half for a presidential election year on record. I mean, that's saying something. It doesn't mean that, it makes sense to try to time the markets, because there is no guarantee that history will repeat itself for the second half of 2024. But when the markets are calm, that is, really when you need to start evaluating your current plan and making sure that you have something in place that can do well if and when, the markets ultimately go down. Because I think the question that we continuously hear and that we continuously ask ourselves is, can the broader earnings growth keep the stock market rally going? So, that's a question that I think is at the forefront of everybody's mind. It should be at the forefront of your mind. It should be at the forefront of the advisor's mind if you're managing money. And a way to really know if you have a good plan in place is if you could point to 10%, 30%, 50%, whatever that percentage of your portfolio is. But you could point to a specific chunk of your portfolio, or a sleeve, or call it what you want, a bucket, that can do well if the markets don't do well, or can at least protect principal if the markets go down. And if you don't have that in place, if you can't at least point to that, if your advisor, if you're working with one, hasn't articulated that to you, then chances are you probably don't have that in place. If you're concerned about that, if you're worried about that, if that's what keeps you up at night, if you're getting ready to retire and you don't know if your portfolio can handle a market shock or a flat to down market over the next 3 to 5 to 7 years, we're here to help answer that question. 630-492-1912, 630-492-1912. Just give Paige a call and set some time up, because clients are worried, questions are fair, and it's our job to make sure that we're helping you answer those questions before something bad happens. So give Paige a call, 630-492-1912. We'll talk about retirement, and we'll talk about what we're doing for our clients that are on the near-term retirement is on the horizon. So more after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
You're listening to the last segment of this week's show. Hopefully you're getting something out of the show. I know I'm kind of all over the place this week, but I think it's important for us to share as much knowledge as we can. My name is Robert Kuhn. I am the host of this radio show. I'm also the president and founder of Kuhn Capital Partners. We are independent. We're a registered investment advisory firm. Our goal is to make sure that we are bringing to the table something that can do well if the markets are down, or can preserve principal. That's generally who we work well with. We work with individuals who want to have some money that can generate positive returns in negative markets. We're not for everybody. You may not have an interest in that. And if you don't, then we may not work well together. But if you would like to have some of your money that can that is predetermined. The outcome is predetermined, where we know going into it what our return profiles are. For example, the bank notes just priced a JP Morgan note that actually priced last week. It was a 12% note, so it's backed by JP Morgan's credit. It is offered by them, and the returns were 12% annual. That's paid 1% a month, as long as the indexes that note we're tracking are not down 30%. So another way to look at it, you have 30% protection to make 1% a month. That strategy now only requires a minimum of investment of $1,000. these used to be high net worth strategies. These used to be where you needed, seven figures in many instances just to get it to take advantage of it. With technology today, the minimum's now $1,000. This is for everybody listening. Think about the benefits of your portfolio if the markets were down, but you had a chunk of money that was still making 1% a month, 12% annual, as long as the indexes that it were tracking were not down 30%. That appeals to you, give us a call, 630-492-1912. Let's have that conversation. Clients are worried. Yeah, there's no doubt, especially if you're near retirement or if you're in retirement. Many investors are feeling financial heat. I think if you look at the ups and downs of the market and the economy, along with stubborn inflation, it does seem to be taking a toll on retirees' peace of mind. And I think they need to look at adapting strategies to their portfolio that can reduce that stress. I think the job of a financial professional is to help retirees obviously just create a plan and create a level of certainty that they are comfortable with. And when we look at the uncertainty in the market and the uncertainty among retirees today, it's significant. It just is. Any way you look at it, I think retirees are facing obstacles to a more comfortable retirement than many have faced in the past. And we see the statistics probably just like you do. Many retirees are feeling less certain about their financial futures, turbulent markets, uncertainty in the economy, the election. I mean, assassination attempts on, a former president. There's just so much out there. 31% of retirees expect to be less secure in their retirement than their parents and grandparents were. 22% of retired investors are worried about their ability to afford monthly bills in retirement. And when you have, clients, and, we work with a diverse set of clients. We have clients that have a couple $100,000. We have clients that have net worths of, $30 to $40 million. And so everybody is all over the board. One of the things that I'm very, very proud of that we do for individuals is we don't care how much money you have. We're here to help everybody. A lot of consultants tell us not to be that way. Only focus on X. Only focus on the high net worth. That's just something that I don't really care to do. My belief is that everybody needs help. I find and get as much joy of helping somebody who has a couple $100,000 to their name as I do that somebody who has, 30 to 40 to $50 million net worth. Why should those individuals that kind of, have under $1 million not have access to the strategies and expertise and intellectual capital of a successful advisory practice that the high net worth has? So understand that when you hear our voice on the radio, if you can hear our voice, we can work with you. We do run the show in multiple markets. We're going to look at it differently than 9 out of 10 advisors, 9 out of 10 advisory firms. Our job is to make commitments. Our job is to make sure that we are committed to you to do everything that we can, that if the markets don't go in the direction that we want them to go, that your plan is going to still be a success. And I think that there's many advisors out there that can't say that same thing. I know that just because most of our clients come from other advisors. And so we can see the portfolios that they had in place before they came to work with us. And I just sometimes shake my head. And I just want, especially when we look back at kind of the statistics, I mean, think about that. 31% of retirees expect to be less secure in their retirement than their parents and grandparents. Yet when we've had just absolutely tremendous growth in the market, man, that is nerve-wracking. And it has to be nerve-wracking to individuals who have amassed a pot of money, and whatever that pot of money is, it is, you're wealthy. Whatever that is, you're wealthy. I'm asked far too often, how do I compare against others? And the reality is it just doesn't matter, because whatever somebody else has doesn't mean that you have that. I mean, I work with individuals who make, 7 figures a year, and they don't have a whole lot saved because they're spending every single penny of it. And then we work with other individuals who, have made $100,000 to $200,000 a year throughout their lifetime, and they have $4, $5, $6, $7, $8 million because they've saved. So we have to look at everybody's situation individually. And when we look at how we can help individuals plan for a comfortable retirement, I think that we have to provide tailored advice to you. Our recommendations, our strategies are there for you to maintain financial stability, for you to make sure that that first and foremost that you're protected. I think if you look at our logo, it's protect, it's grow, it's reduce taxes. That's what's in our logo. Protect, grow, reduce taxes. And if we can always focus on the protection side, we've always had a belief that if we can protect, if we can deliver principal protection or even gains in a down market, then the growth component, which is in our logo, that takes care of itself. And then lastly, that's going to bring to the table how can we allow you to keep as much as you had, which is obviously reduce taxes, reduce taxable income, and incorporate strategies that can do that, protect, grow, and reduce taxes. And so, when we look at what retirees are looking for, I think they're looking for that comfortable retirement. I think they're looking for that peace of mind. I think they're looking for the ability to know that even if the markets drop 10%, 30%, 50%, whatever that number is, even if we're down for an extended period of time where the markets are flat, like I mentioned earlier in the show, do you know how your portfolio would do? Or if I told you the markets were going to be flat for the next 5 years, what would you do with your money? Even if those scenarios happen, we want to make sure that our clients, our investors that entrust us, know that they're going to still be able to meet their goals, their spending goals, their whatever goals it is that you ultimately have in retirement. And that's our job. And our job isn't to bring cookie cutter strategies to the table. Our job is to bring the strategies that we would consider for our personal money, for our personal assets, for our personal investment strategy. We want those strategies to be brought to our client strategies. Because again, if you've heard nothing today, hear this. There's a good, strong likelihood that how your advisor is managing or is investing his own money, his immediate family's money, is different than he's advising you to invest. Because I think a lot of times, and the advice that is given from investors, from financial advisors, is how they can scale, what strategies are going to help best them scale their business, grow their revenue, rather than what's best for the client. So if you've heard anything that I've talked about today that piqued an interest, give us a call, 630-492-1912, 630-492-1912. Hopefully you got something out of the show. I look forward to being back with you next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.